Well, hello and welcome to Global Mantra, the show that profiles prominent fund managers from the City of London and gets their views on the global market picture. Joining me on the show today is Mr. Sam Mahtani, who's the Director of Emerging Market Equities at F&C Investments. F&C globally manages about $150 billion. Their EM portfolio, particularly as far as equities is concerned, is roughly about $5.5 to $6 billion. Sam, it's great to have you on the show. Thanks very much for taking out the time. You know, you cover India very closely. Your key markets are India, China, and Korea. So what's the sense about India, particularly at this point in time? I mean, after the fall that we've seen from the start of the year, how are you approaching the story?
Well, we think the India market is actually starting to look a little bit more interesting now. So far this year, we've been slightly cautious of India, but we are turning a little bit more positive. And actually, we think the India market could actually bottom in the next 2 to 3 months. Certainly, the macro picture is turning. We think that concerns on inflation and interest rates will actually recede over the next several months. We're already seeing signs of inflation actually softening. And, you know, bottom up, we're seeing some good opportunities actually emerge. I mean, as you know, the overall market's trading on around about 12 times forward earnings. So, you know, valuations are certainly a lot more attractive in India than a few months ago. So we're more constructive on India now than we were at the beginning of this year.
But when you talk about India bottoming out in the next 2 to 3 months, how much more downside is there to the market? I mean, how much do you see, and at what price to earnings level would you want to kind of change your portfolio around in India?
Well, I think you know, over the next couple of months there will obviously be you know, volatility in the market, given, you know, the geopolitical environment is obviously still very fluid. I think we could possibly see another 5% possible downside from here. But I mean, I think that there is definitely an opportunity building up now in India, and I think, you know, I would be advising all long-term investors to start thinking about, you know, what stocks they would want to be buying, you know, in the next 2 to 3 months, because I think it genuinely, you know, there will be an opportunity to basically pick up some really good quality stocks over the next 2 to 3 months at very attractive valuations.
What have you been doing over the last 3 months? How are you looking at your India portfolio? I mean, have you changed around positions?
Well, we were very overweight India throughout last year, and we actually pared that back quite a bit in November, going back to neutral. But more recently, we've, as I said, been looking around for decent investment ideas, and we started gradually putting money back into India on a very selective basis. And you know, this is something we're going to be continuing to do over the next couple of months. You know, as I said, as we believe that the market's, you know, close to bottoming out, and you know, we're getting some very good signals on the bottom up side as well in terms of some good stock ideas.
Could you share some of them with us?
Yeah, I mean, primarily what we're doing is sticking with the larger cap stocks. That's one of our sort of key investment philosophies that's worked us well over the last several years in India, and we're sticking with that philosophy. We think that you know, if investors do come back into India, they will basically go into the larger cap quality names, and that's one piece of advice I would certainly give out to investors in India. So companies like Reliance Industries, ITC, Bajaj Auto, you know, good quality management, companies with some sort of secular theme attached to them as well, companies with good earnings growth. They're the types of companies we're looking at. Ken as well as another company that would fit into that, you know, into those categories.
You know, the criticism for Reliance has been that over the last 1 year the stock has not moved. You think there is an interesting time to get into the stock at around about the 990 odd levels?
I think now is a very interesting time for Reliance actually, and I think the underperformance is actually you know, a good opportunity to look at Reliance. The BP deal obviously you know, puts a floor in terms of it gives you a valuation for the whole exploration and production business. Analysts had different estimates in terms of, you know, their value of that business, and now you've got a you know, a value that you can attribute to that business. But more importantly for Reliance, it obviously brings in an important strategic partner. It helps them slightly de-risk the business as well, because obviously BP has clearly got a lot of expertise in the E&P business. But more importantly, also they, I think investors will see and start focusing on again the improvements that you're going to see, and you have seen in the refining and petrochemical side. I mean, most of the Asian petrochemical companies have done extremely well in the last 6 or 9 months, but Reliance has not participated in that, in the performance. And I think, with the BP deal, people will start focusing on the two key businesses, which is refining and petrochemicals, where there's been a big improvement in margins for them.
Post the fall, you want to look at consumer stocks again in India?
Well, I think you've got to be really selective in the consumer area. ITC definitely fits the bill in terms of the type of company we want to own. It's sitting in an industry where there's a very long-term secular theme. Clearly, also they will benefit from higher consumption and higher incomes within the Indian population. Obviously, also they benefit from the rural exposure they have, and the fact that rural incomes are obviously growing very strongly as well. The valuation is high. It's on, as you know, about 20 times forward earnings. But I mean, for a company which is delivering an ROE of above 50%, again, strong management, strong distribution. I mean, and a great track record in terms of shareholder returns. We think for that type of company, 20 times is okay, given that we think they can grow their earnings by about 15 to 20% per annum over the next few years.
What about banks and financial companies in India?
Well, I think banks is probably going to provide the biggest opportunity for investors over the next 2 to 3 months. That's basically premised on our view on interest rates and inflation. We think it's widely known that interest rates will go up a little bit more in India. I think that's very well discounted by the market. Inflation is the area where there's still a bit of debate. We do think that actually inflation has pretty much peaked out in India. We think it will gradually decline. There's still a lot of people out there who are concerned about inflation and think there could be another move upwards in inflation. However, we think inflation's under control. Interest rates will go up moderately over the next 6 to 9 months, and because of that peaking out of interest rates, we think that there's an opportunity now emerging in the banks. And if you take the sort of two categories, the private sector and the public sector, I mean, there are good opportunities in the private sector banks like Axis Bank, but I mean, I think the most money will be made in the public sector banks, and banks like Bank of Baroda, State Bank of India. I think there's definitely money that you're going to make in those types of banks.
We just, of course, came out of the budget. What did you make of the announcements that came by, whether it was a 4.6% deficit target, or even for that matter, the target laid down on divestment in a market environment which, as you pointed out, is going to be seeing volatility over the next 6 to 12 months?
Well, we thought the budget was pretty similar to previous Indian budgets, really, which is a gradual signalling of reforms, sort of heading in the right direction, but no sort of big bang announcements, which is generally what we would expect from an Indian budget. Clearly, there's been a lot of sort of debate about the expenditure targets and the fiscal deficit target, and most people are assuming that the government's not going to meet their 4.6% target, and there's clearly some chance of slippage there. But overall, I think the budget continues with the sort of long-term reform program in India. I mean, there were some positive elements in the budget, and even if there is some slippage, we think it's probably going to be fairly modest. In terms of the divestment target, obviously, ultimately, it depends on the price that the government's willing to sell these stakes at, and the companies that they're looking to privatise or divest stakes in are good quality, long-term stories, and therefore, as long as they're pragmatic on the pricing, I think they will be successful, and they have been pragmatic in the pricing over the last 12 months or so in very difficult market conditions. So I would imagine that the government will continue to continue with that policy. Because
the market, of course, is expecting two large issues, the follow-on issues from ONGC and SAIL. Do you think, given market conditions and given pricing being favourable, those issues will be very well received from the foreign investor community?
Well, as I said, I think it all depends on pricing, and as long as they're pragmatic on pricing, I think they will. These are two high-quality, large-cap companies, which there will be appetite for them as long as they're the pricing is realistic and reflects the market conditions at the time.
All right, Sam, we'll take a break on that note. But when we come back, we will understand a little bit more about how Sam allocates money across emerging markets and his investment philosophy while going about selecting stocks and sectors in these regions.
Looking quite seriously at India, but also we are looking at China and Indonesia as well. And the big call really, when you feel inflation and interest rates are fully discounted, the rise in inflation and interest rates is discounted in those three key markets. Mexico, again, we're warming up to. We're still trying to find some more investment opportunities there, but we do like some of the companies there.